Good evening, and thanks for joining us tonight. And welcome in Houston to our watch party at the Houston Center for Contemporary Craft, co-hosted with Fresh Arts. So if you're watching us as a group, thanks for tuning in. My name is Elisa McCain, and I am the Executive Director of Texas Accountants and Lawyers for the Arts. I'd like to thank our primary funder for the evening, the Texas Commission of the Arts, a long-term supporter of TALA, and we appreciate your annual gift to us this year, paying for the Art of Taxes programming. I'd like to take a couple of minutes and just run through what we do. Many of you probably know, but I'll just do a quick refresher. In addition to doing these educational programs, our signature program is a matching service between attorneys and accountants and artists or small nonprofit organizations or inventors, and that is at no cost for consultations and for legal and accounting work. So I'd like to talk about this for a second. These are some sample assistant topics that we could help you with if you are an artist. We can do intellectual property, all sorts, patents, copyrights, trademarks. We do contracts. We can do gallery agreements, consignment agreements. We can do licensing agreements. We can do a little bit of HR if you have to pay people or if you are employing people. We can do liability waivers if you're doing some events or shows. We can also help you on the accounting side. We can help you, give you some QuickBooks advice that we don't set up your books for you, but we can give you lots of advice if you're wanting to take that on yourself. We can also give you general business and tax advice like we're doing tonight. Pretty much anything that is associated to running an arts practice or an arts small nonprofit. Maybe we should say what we're unable to help with. The big ones are criminal law, and we don't sue people and we don't litigate. So if you have those, you would need to find another type of attorney. To qualify for this service, which is free or no cost legal services, it is financially based. For one person, you would need to make under around $48,000 a year, and that limit goes up. If you have two people in your household, a spouse, a child, that goes up to around 65, and it goes up depending on how many people are in your household. All that information about qualifying for this pro bono or free program for attorneys is on our site. So I invite you to look there. We're happy to also answer any questions. We also do have a program for inventors if you've invented something. And we also have programs for nonprofits that are arts nonprofits that are below $200,000 a year budget annually. You ask, how do you get involved? If you're interested in this and you think that you qualify, you would need to fill out a form to become a member and pay $75 if you're an individual artist and $250 if you're a nonprofit. And at that point, you can ask as many questions as you have regarding your artistic practice for an entire year, and then we would recertify your income again. If you're an inventor, it's just a flat fee of $100 for us to help you file your patent. Before we start, I'd like to talk a little bit about tonight. This Art of Taxes program is kind of a three-part series. This is part one, where we're going to give you some comprehensive information about taxes, specifically federal taxes. And we are going to offer 2 weeks from today at noon a special lunchtime event with Lisa Srtinovic about federal tax deductions only. We found out from doing this many years that a lot of times we get bogged down in the deductions part, and then we're zipping through the very end of the seminar. So we decided this year we're going to do a special hour on deductions. So we're still going to cover deductions tonight, but if you would like to dive deeper or you have some really specific questions, it would be great if you could tune in next 2 weeks from today at noon and hear Lisa go over just deductions solely. In addition, if you still have questions and you still need help, the 2 weeks prior to the deadline on April 15th, we will be doing Monday night open office hours with Lisa and Kathy. So this is your chance to come on Monday night, March 30th or Monday night, April 6th, and ask your individual questions. And that's about 2 weeks and a week before the tax deadline. So that gives you hopefully 3 chances to learn a lot. If you file your own taxes, we really hope this helps you out. Even if you have an accountant and you're joining us, it's great to know what's on the form. It'll just help you get organized, and your accountant will love you even more. Just a reminder, for questions tonight, if you would like to comment on the YouTube channel, you need to have a YouTube account. So if you have a YouTube account, please just register for that and then watch through your account, and you should be able to talk to us. If you don't have an account, it's free, and it just takes a couple of seconds to set up if you'd like to be able to access the chat and participate. So with that, I am going to turn it over to Houston-based attorney Kathy Ploch and Austin-based attorney Lisa Svrtinovic, who many of you know and have probably talked to before. And they're going to take you through this evening's program, and I'll be back to see you at the end. Take it away, Lisa.
Thanks, Elisa. Just one little clarification that both Kathy and I are CPAs. We are certified public accountants and not attorneys. So although we will be discussing a few things tonight that overlap with like things like legal structures of a business, we come at it from the tax and accounting perspective and not the legal side. TALA does have a phenomenal amount of legal counsel, and highly recommend that if you've got more questions about that sort of thing, that you plug in with TALA. But for tonight, we're going to think about mostly CPA tax-related stuff. As you can see, we've got a really packed agenda tonight, so we are going to kind of move it along a little quickly. Again, if you miss this live session, it will be up on TALA's YouTube, so make sure you check it out there. Well, first thing, Kathy, do you have anything to say?
No, I want to welcome everybody again. It's tax season again. I can't believe it's here. It's officially here since the Super Bowl is over with, as far as I'm concerned. So that was an interesting game. But yeah, we did get a new tax bill last year, and so there's probably some stuff that that I think is important that we haven't either had, or some things that have come kind of back to this. So I will let Lisa take it away, and as always, we're always here to help. I will try and while she's talking, if you have questions, I'll try and answer them while she's talking. And if it's something that we think everybody would be benefiting from, I will certainly stop and answer those questions or refer to those questions. So
fabulous. So because we are like just thinking about filing our 2025 tax return, not the 26 tax return, most of what we're going to be talking about is focused on that tax return, but there are a bunch of things coming in 26 that you need to be prepared for. So we're going to throw those in there too. So just keep in mind that we've got a lot of tax rules coming down the pike here. One of the first things that you have to think about when we're talking about taxes as an artist is, what kind of tax return do you file? Am I self-employed? Am I an independent contractor? What does all that mean? So that's actually where we're going to start, is what does it mean to be self-employed? And the definition by the IRS is either a sole proprietor or an independent contractor is someone who is self-employed. And like a lot of people, they use those terms interchangeably, but the sole proprietor is both a legal term and a term that is referred to by the IRS. And it really means someone who runs a business all by themselves, and they are not incorporated, and they don't have a separate legal structure around them. That's important because if you are a sole proprietor, then you have a very specific tax return that you have to file. And that has implications on what you need to do with regards to how you file your taxes and how you pay in, like on a quarterly basis, or do you get a W-2? An independent contractor could potentially be someone who has a corporation. That's important to consider when you hire someone to do a service for you. If they are an independent contractor, you need to know whether or not they are a corporation if you're thinking about whether or not they get a 1099. So even though these terms are very, very similar in the sense that from your perspective, being a sole proprietor and an independent contractor could be one and the same thing, it's a possibility that they're not. The independent contractor piece is as the person who's done the hiring, or as the company that has done the hiring, I have the right to tell you what outcome I want, but I can't tell you how to do it. And that's the key differentiator there. We just sort of talked a little bit about being a sole proprietor. That really is the absolute easiest way to start a business. Is the IRS's definition of someone who is in business is the exchange of goods or services. That means you give another entity either a service or a product, goods or services, for compensation. That's typically money, right? Somebody's going to pay you to do something or pay you to give them something. And particularly if you're thinking about a business, it's with the intention to make a profit. So Kathy, thinking about that, what's an example of someone who is exchange goods or services for compensation maybe, but they're not a business?
Well, it could be something like I might have paid my daughter to do something. I might bill her some money, for her to go do something for me, or like reimburse my great grandson's birthday gift or whatever. Now, it's not necessarily a good or a service, but I do give her money. But, she's not in the business of doing that.
She's not in the business of doing it, right? Sometimes I hear from artists that I'm a freelancer and therefore I don't have a business. Okay. If you aren't doing it to make a profit, you're correct. You have a hobby.
Mm-hmm.
We're going to talk a lot more about that a little bit later, but if you have a hobby, you still have to pay taxes on that money that you get in. Now, if you're reimbursing for your great-grandson's birthday gift, that's neither an exchange for goods or services at all, right? So only in this instance of exchange of goods or services, is it really matter for whether or not you claim that income or not. But when we're thinking about structures for your business, the sole proprietor is you just decide, just because, that you want to go and be a business. As long as you've got that profit motive, then just like this, if you're only one person, you have a sole proprietorship. No, you don't have to write anything down. You don't have to tell the IRS. You don't have to tell the state. You just have to decide. Now, are there some things that make it more official? Absolutely. For example, you might want to get an EIN, an employer identification number. You would absolutely want to have a separate business bank account. These things help you look more legitimate like a business, but you don't have to, right? Just the exchange of goods or services for compensation with the intention to make a profit. And there's only one owner, that makes you a sole proprietor. As we're thinking about these other structures, partnerships, limited liability companies, these sort of things, there's three things that you want to take into consideration. You want to think about risk. So when we think about a limited liability company, oftentimes we think about it, well, I'm going to protect my personal assets by forming this limited liability company. That's fantastic. And the limited liability company certainly does that, but you don't have to form an LLC to be a business. A sole proprietorship is a legitimate business with, it just doesn't happen to have that liability structure around it. So there is risk. There is ownership. That's how many people are involved. If there is just one, like in a sole proprietorship, sole meaning one, right? Then there's not a lot to think about. There's a sole proprietorship. You've got the limited liability company. You can even have a corporation with one owner in it. But so there's ownership. But if you have more than one owner, you absolutely you cannot have a sole proprietorship, right? Because that just means one.
Lisa, I have
Yes.
a question.
So I have an answer.
What if both me and my husband we're both artists and we want to engage in a business together? Do I have to be a partnership, or can I be a sole proprietorship?
That is a fantastic question, Kathy. And in the state of Texas in particular, because it is a community property state, as long as there is one person that decides on whose social security number that sole proprietorship is going to be under, we can have just a sole proprietorship and file. I'm going to get all IRS-y on you here, okay? File a Schedule C with your 1040 tax return. That means your personal tax return, the one that you do every year. You'll just add one more schedule to it, which is why the sole proprietorship is so valuable. It's easy to set up. Again, you don't have to tell the state or the IRS or anything. If you and your spouse, your legally married spouse, go into a business together and you decide, talk to Kathy or I, right? Get a membership with TALA and have a consultation with us and make sure that that's the best thing for you guys. But from a tax perspective, it makes sense to have just a Schedule C with one person's social security number. Now, a downside to that would be if both of you need income for Social Security purposes, right? You might want a partnership thing for that, but the partnership, as we're going to see in the next slide here, you have to have a separate business return. That then, okay, so you have your personal return, you got your business return. Both of them costs money to do. Even, well, the personal return, if you make under, Kathy, is it $85,000 this year, 89,000? Then you can use Free Tax USA. But the other return, the business return, you're going to have to pay something to actually get that done, whether that's TurboTax or a CPA or an enrolled agent. You're going to have to pay to get that done. And so you need to really talk through whether or not having that partnership is the right situation for you, as opposed to just having the sole proprietorship. I see that we have a question about the live stream being made live. The answer is yes. It's going to be on the TALA YouTube channel, so make sure you subscribe to that. And another question about when is it required to file quarterlies rather than yearly taxes as a sole proprietor? Ooh, this is actually on this slide about the fact that usually you need to file quarterly estimated taxes if you have a sole proprietorship. The reason for having to file Form 1040-ES is IRS is a pay-as-you-go system. And if you've ever worked a W-2 job where they take money out of that paycheck before they give it to you every 2 weeks, this is the equivalent when you are doing it yourself. A downside to the sole proprietorship is that you have to pay both the employer and the employee tax. And so it feels like you're paying a lot more. The question, Kathy, this actually, you're going to address this a little bit later. can you give us the gist of the difference between, or like I can think about an example of why you wouldn't want to pay a quarterly tax might be if you have a loss that quarter. There's, 0 times the tax rate is still 0. So you wouldn't pay anything in that quarter. So that's an example of a reason why you might not do it until, the end. Really quick, do you have anything else?
Well, obviously, if you said if you have a loss, but obviously, if you're just starting out, if you're just starting the company, you may not actually have very much income. And so, that would be certainly another reason why you wouldn't want to pay that. It makes it a little bit easier if you've already kind of established in your sort of, evenly split, even if you have somewhat of an even flow of income, makes it a lot easier. But, it's difficult. And what you don't want to have is to not pay anything in, and then here it comes April 15th, and you've got this, big $2,000 or $3,000 tax bill that you don't, have any income. You might not have any cash to be even able to pay it at that time. So, and we'll talk a little bit more about doing the estimated payments later on, but yeah.
So
it's hard.
A suggestion is that even if you don't plan to pay until April 15th, that at very minimum, as part of your record keeping process, that you set aside that money and don't spend it personally and don't spend it on other things in the business, because that really belongs to Uncle Sam. And so you want, even if you don't pay it in on a quarterly basis, make sure that you've got it set aside so that when you do get to that $2,000 or $3,000 tax bill, that you've got the cash in hand. Keeping in line with the thought process around why a sole proprietor is so easy is that it's filed with your regular personal tax return. So that would be just April 15th, and you don't have to think about anything else. If you extend it, it'll be October 15th. And so it just makes it really, really easy to file taxes as a sole proprietor. A partnership kind of is the next easiest thing as far as business structures. We highly, highly recommend that you have a written partnership agreement, but in the state of Texas, a handshake is all it takes. And so you do have to be careful about, especially as artists, you guys tend to collaborate a lot. And it's really, really important that you are very clear about what kind of agreement that you have with each other, whether it's actually a separate legal business that you need to file a separate tax return for, like a Form 1065, because the sole proprietor, as a Schedule C, with their personal tax return, that was due on April 15th. But if you look at when this tax return is due with the partnership, it's due March 15th. So if you guys accidentally became a partnership, you need to know that that tax return is due earlier than what you're regularly used to. So it's really important that you think about that sort of thing when you're putting together a band or when you're doing some sort of collaboration that might look like a partnership. Again, TALA would be a really great resource for you because you can go to the legal team and say, hey, we're thinking about this. Is the partnership the right way to go? When we talk about limited liability companies, which is probably one of the second most common question I get, is should I be an LLC? And the answer is we're going to go back to the 3 things: risk, ownership, and tax. All right. So the first one, risk. LLC, limited liability, and same with the limited liability partnership. Limited liability, in the name, it says that, hey, you're going to protect your own personal assets and the assets of any other entity that you happen to own, by having these little bubbles of legal protection around the businesses. But the IRS doesn't see a limited liability company as any particular tax thing. By default, if you only have one owner, you would get taxed as a sole proprietor. So that's, I think, one of the most confusing things for people. Well, if I get an LLC, will I get better tax position? And the answer is, sorry, Charlie, right? You're most likely going to be taxed exactly the same as you were before the limited liability company, but now you have that protection around you. Now, one thing it doesn't protect you from is actually if someone sues the limited liability company, it has access to all of the assets within that. That means your bank account and any intellectual property that you have in there. But if they sue you, you still have to pay. So one of the things you need to remember with regards to risk is that you may also want to have insurance so that if someone does sue you, that insurance can cover the amount that they sued you for, or at least help partially mitigate that risk. If you have more than one owner, then that LLC will by default be a partnership tax return. Now, the cool thing about limited liability companies, when you have enough income, is that you can have some tax benefits. Again, remember those three things, right? Risk, ownership, and tax. Well, because the IRS doesn't see that limited liability company as a taxing entity, yes, by default, you would be a sole proprietor, but you can make an S election to be taxed as an S corporation and file Form 1120S. There are some potential tax benefits to doing so, but really they don't kick in because they cost more from an administrative perspective for your company to do. And so the offset doesn't really happen until close to $75,000 in net profit. So yes, you should talk to Kathy and I about an 1120S, but just because you set up an LLC, don't jump immediately to it.
Lisa, we got a couple of questions real quick.
Awesome.
So if you're able to, we started a multi-member Texas LLC, not a corporation, late last year with no net income to report. Do we still need to file or plan for fees?
Aha. If the if it was legally set up, so you have articles of formation from the state in 2025, so last year, then you would absolutely have to file at very minimum an information report for the Texas franchise tax.
Yes.
Okay, so that's form number 05102. And if you don't file it, then you will be out of compliance with the state and you can't do business in the state of Texas under that LLC. You also risk, because you're not allowed to do business, you risk, I mean, the whole idea was to have this LLC to put this bubble of protection around you. And if you're not allowed to do business in Texas and you come up with some sort of lawsuit, the judge might find that the LLC was null and void because you didn't follow the rules and rule that now the LLC was not in existence as far as the protection goes. So not a lawyer, but it's something you need to think about. Kathy, what about on the
Well, I was just going to say, if they're saying that they're a multi-member LLC, my thought is, do we have a partnership return that we have to do? And even though you say, because what you just referred to was the state, yes, you do
The
have
state.
to file
Mhm.
the public information report. But from a federal standpoint, if this is indeed a 1065 partnership, which I'm thinking it might be, even though you say you had no net income to report, did you have expenses? Because even if you had legitimate expenses, you should file that return, because then all of the partners are going to have some losses that they can offset their regular income on. So
And
I would say,
at
yeah,
very
you have
minimum,
it.
right, at very minimum,
Yeah,
they've got the $300 fee that they had to pay to the state to
right,
get that LLC.
right.
So we know they had at very minimum
Yeah.
$300 expense.
Yeah. And the other question is, if it's a sole proprietor, can you still create a business name? Will the business name be protected? Yes, you would get a DBA. Most people get a DBA, and that's what, still for 10 years. Is that right, Lisa?
I believe it's 10, yeah.
Yeah.
So if you get a DBA, and with regards to protection, again, Kathy and I are not lawyers. Is the business name protected? It's at the county or the state. Well, in a sole proprietor without an LLC, a DBA is at the county level. I happen to be in Travis County. It costs $24, a little less expensive, but it's only going to be valid to be protected, I guess, in the county that you happen to be operating in. So, and the business name itself is protected, but as far as if someone sues the organization, then because it is you are fully liable, then you're not protected in any way from that perspective. Corporations are completely separate legal entities, just like limited liability companies. They limit the liability of their people that own the shares, but you do have that double taxation if you are taxed as a C corporation. What does that mean, Lisa? That means that the corporation itself pays a federal tax, federal tax, and then when the money is distributed to the people who own the shares, well, they are also taxed. So that means, it's kind of taxed twice. And so, if you work for the corporation, then you would get a W-2, and then that is taxed on your end as a personal income. So it does feel like there's a double taxation there. It works for a number of different reasons, but it is not the most popular entity type out there. If you're just starting out, unless you feel like you have a pretty high risk, you might just want to start out as a sole proprietor, just to make sure that you have a viable working business. Let's say that you've been doing art for 6 or 7 years as a hobby, and now you have the intent to make a profit because you really believe that this year you can get out there and go to festivals and get into farmers markets and get some gigs in different ways. And so this year you want to really do it and do it right. Again, sometimes it's just as easy to start with that sole proprietorship. And then if the next year you're going good, think about that limited liability company for that added protection. If you are concerned about the risk piece, there's always the option for insurance in that interim or in addition to that LLC. The S corporation we alluded to a little bit earlier with the limited liability company. because it's this one thing that you can get some really great tax advantages by having an S corporation. It can save you money on taxes. But again, there's so much administrative work to it. You absolutely must pay yourself a reasonable wage through a paycheck, which means that first of all, you've got to have enough cash flow to pay yourself a reasonable wage. Second, you're going to have enough cash flow to pay for that payroll service to run the paycheck and send the money and all of the reports that go along with payroll to the IRS so that you don't get in trouble. Because of all of the taxes that are out there, I think that payroll taxes are the most notorious for getting yourself into a little bit of hot water if you don't do them right. So with regards to the S corporation, I highly recommend that you put it off until you have, like I said, around $75,000 in net income. That starts to be the point where it starts to pay for itself. Before then, unless you've got some really good math going and your trajectory is going really up very quickly, the S corporation is going to cost you more headache than it's really worth.
Well, and I would say too, what I'm seeing on my clients, that we're actually having some of those S corporations go down to a C corporation, because what's happening is they're making so much money that the corporate tax rate is at 21%, but you can be at a much higher rate depending on how much the income is that S corp is making. So there is a point to where, you might not want to stay at an S corporation. You may want to go to a C. And that's what I've had 2 clients this past year do for that. But I would keep it simple. I would do the KISS, right? Keep it simple, stupid, as much as you can.
Absolutely. Especially, if you're making, again, less than $75,000 a year in net profit. So that means all the money that you're bringing in, let's say you bring in, people paying you for that exchange of goods or services is $100,000. If you've got $60,000 worth of expenses, then you've only got $40,000 of net profit. That's what, as a sole proprietor, you're going to pay tax on. Until that number gets to be about 75, the S corporation election doesn't pan out too well. We do have another question about business insurance. What kind do we need and how much do we need? Kathy and I are not insurance experts at all. So I would recommend that you talk to an insurance broker or an insurance agent about at least general liability insurance. And it also kind of depends on what kind of business you are. So, for example, my husband did, he has a music production company, and he did live sound engineering for Austin Community College. He was required to have general liability insurance for that thing. And same with a couple of muralists that I know, they were required to have general liability. So that's at least a good start to have a conversation with your insurance broker. But we're not the experts there. So you should definitely seek their counsel. And then for protection of DBA, so for protection, DBAs are not advised, or would you recommend them for just selling your artwork here and there until you're ready for an LLC? I love the DBA. The DBA is kind of like your stage name. So my husband is Milan Sretanovich, but his stage name is Minya and Johnny Stigley. So Minya has certain kind of music that it puts out, and Johnny Stigley is another one. Those are DBAs. So it's like your stage name. It gives you an ability to do some marketing. It helps you get your name out there. It also helps if there's another person with a similar name that they can't, they can't do anything that gives shoddy work, right? So if they're out there and they're saying that they do really great work, and then they show up and it's all kind of sloppy and messy, that's not, that would potentially reflect bad on you if somebody did a Google search and found you also, right? So that's why the DBA is kind of nice to have, so that you can protect your reputation. And then the next question is, so different DBAs can fall under the same LLC. Oh, can fall under the same LLC. The answer is yes, they can, but you don't want to confuse your audience. So you don't want to have too many different things. In addition to that, if you've got, if you do wedding paintings, and then you also do skydiving photography, well, one is going to be really, really risky, and the other one isn't so much. And they appeal to two different audiences. And if they are too dissimilar, for example, I am a CPA and my husband is a music producer. We have two different, Kathy, off the top of my head, is NAISC code.
Yeah, NAISC codes. Business codes.
We have two different business codes, and there is a potential that there are different tax rules around that industry. So, for example, photography has to be taxed at the Texas state tax level, right, for sales tax. And if I got mixed up in that, then there might be some implications from the state that says, hey, if you're going to be in this photography business, then you might have a thing that also is taxed. We have another question that is, are there any issues that arise if I have a legal name and an, okay, so this is a little bit more of a legal question, which would be great to throw to the TALA legal team. We're going to jump back into taxes, guys. So now we're to questions, which great, because we have another 1099 question.
Yes.
So the question is, I work for the crew for a band and receive a 1099 NEC at the end of the year. Aha, very good. Should I be filing a Schedule C and treating my job as a sole proprietorship? I'm going to go back and ask you the question. Do you do this as a hobby, or are you doing it to make a profit? Is the intention to do this and put money in your back pocket, or would you be in the crew just to have a good time? If you really are intending to make a profit, then if you file the Schedule C, you get to take mileage. You get to take a portion of your cell phone, portion of your internet. If you have a dedicated space at home that you use to do the rest of the work that you do, I realize that when you're with the band, you're out and about, but you have some administrative things to do. If you intend to do this and make a profit, then you would get to take all those expenses against that profit and lower your taxes. Now, if you would do it anyways, and you didn't want to worry about taking all of those deductions, then you don't have to be filing a Schedule C, but you do have to count that income.
Yeah. What about the question? What about taxes if you want to sell something overseas?
Oof. Well, that would include the taxes for the country to which you are selling that item. Often that has a VAT tax. And this particular tax webinar is focused on IRS taxes and the state of Texas. So I'm hesitant to talk about the overseas beyond the fact that it's really about where you're selling to and not where you're selling from. So now the thing to think about there is, from a federal tax perspective, Kathy, if they are here in Texas and they are selling to, Brazil, they would still have to count that money that they got here in the States on their federal tax return.
Correct. That is correct.
Yeah. So I hope that answers at least to a little bit of an extent. Again, that's a great question that you might want to pose to TALA to get one of us to talk to you a little bit more about what that might mean. As we think about, oh my gosh, let's go back to the question about the 1099 NEC and him being in the crew for a band. I talked about maybe that he could deduct, a portion of his cell phone and some mileage. Well, this is where the record keeping best practices come in, because if you are having the intention of being a business, if you are really meaning to make a profit, then you're going to have a little bit more than just this shoebox of receipts. That's more like a shoebox of shame, right? It's you need to be a little bit more organized than that. So one of the things that I've seen a lot this year is, but Lisa, I get my bank statement. That's good enough. And the IRS says, sorry, it's not. You really have to have the actual receipt. But why? Why? And the answer is because the receipt itself shows you the detail of what it is you purchased, not just the fact that you purchased something. And that you have to be able to substantiate the income and the deductions that you're taking on your tax return. And so you really do have to have the actual receipt, not just the bank statement or the credit card statement. There's a whole bunch of different ways that you can track that income and expenses. The easiest one, sure, is that shoebox. But then you have to, at the end of the year, when you have to fill out the tax return or give it over to your tax preparer, you still need to have it more organized. And if you have a limited liability company or a corporation in the state of Texas, you are actually required by the state to keep financial records. And this shoebox doesn't count as financial records. So think about if you're good with a spreadsheet, you might want to just throw it in there. I have a spreadsheet that I give out to a lot of my clients that is just all of the line items on Schedule C, just boom, 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 boom. And then left to right is the month. And so just as you get a receipt, you would put that there is $5 in meals. You really do want a separate bank account, a separate business bank account. We found out during the pandemic that if you did not have a separate business bank account, then you couldn't get the PPP loan. So that's really important. And almost all banks require that you have a federal EIN. Now, you don't have to have it, but if you're a sole proprietor, if you're an LLC or a corporation, you must have an EIN. But I highly recommend it anyways, because when you have that, The IRS tends to think of you not as a hobby anymore. You start to look and act more and more like a business. So again, you can do manual bookkeeping, but there's so many computer programs out there now that are designed to help you do your bookkeeping that that makes sense. The most common one that everybody seems to know is QuickBooks Online, but it's becoming a little on the spendy side now. So you might think of Wave, W-A-V-E. There is a free version of it. So I highly recommend looking at that. It's a very simple program, but it's great when you're first starting out or your income isn't that, it doesn't have the budget to account for, $75 to $100 a month for the software.
Lisa, a couple of things. Number one, I just wanted to go back to the EIN. You can just remember, you can get that EIN on the IRS website and it's free. So don't think that it costs you to get an EIN, because I've heard that in the past. We do have one question here. What if you are doing everything, you're trying to make a profit, but you aren't quite making it yet? Can you still claim deductions for a time, until you are making a profit? And the short answer is yes, but you don't want to continue. You don't want to have 3, 4, 5 years of that, because then there's something wrong with maybe what you're doing or whatever. I mean, it's okay to do it for a year or two, depending, especially if you're just starting out. Maybe you're starting out in November of 25. You don't have any profit, or maybe it was 24, maybe in 25 you didn't, but you should start doing something and get some coaching from Lisa or something, because you need to, you should be in business to make a profit, and it's okay if you don't, but at some point that, if that's your only income, then you're going to have you need to be able to sustain yourself and be able to eat. So
yes, I like that eating part. The IRS does have kind of a rule that says you should be making a profit 3 out of every 5 years. They do have a provision that says if you are a startup, we're going to give you a little bit of a grace period. So yes, you've got it, and you absolutely want to file that tax return. As we pointed out earlier, there's startup costs that you can deduct. There's, when you're first starting out, you need to do a lot of advertising there. You need to buy a lot of software. You might need some supplies and materials to get yourself going. And the IRS understands that. But if you haven't started to change your behavior so that you are making a profit, then you start to look, especially in the arts, it's a little bit more like a hobby. Why? Because we're passionate about this. I mean, this is something that we do because we love. And the IRS is like, well, we don't want you scamming us by just taking all of these deductions. So our expectation is that you're going to make a profit. But absolutely, even if you are not making a profit, I want you to go ahead and file the tax return and claim those deductions. But I want you to be learning that you want to be making that profit and changing the way that you do business so that you start going down that road. We talked about NECs earlier with the band crew, right? Quickly, they were due on, if you as the business needed to give somebody a 1099, they were due on January 31st. But if you have not yet filed it, highly recommend that you do so soon, because penalties start around $60 for everyone that you haven't filed. So get those in soon. There is a kind of a decision flow when you're thinking about who do I give a 1099 to? And the first question is, are you in business? I know that we've just talked a lot about being in business, But let's say that you decide, no, I'm just going to be a hobby. I'm just going to pay the tax on that total amount, and I'm not going to take any deductions. If that's the case, you are a hobbyist, you do not give anybody a 1099 because a hobbyist is not a business. Only businesses give 1099. So that's the first criteria. Are you a business? And then second was, did they perform a service for you? There's kind of only two things that the IRS sees. There's goods and there's services. A good, in your mind, like if you're an artist, a painter, then goods are, help me out, Kathy, canvas and paint and things that you know, material.
Your supply, your brushes. There we go. I'm like,
brushes, right?
Your brushes and
right. So it's only if somebody does a service for you. Software, like QuickBooks, is not a service, so you wouldn't give them a 1099. But if somebody washed your brushes for you, I don't know if anybody does that, but if they were to, then that would be a service. And so then you would go, and if you answer yes, then you go on to the next step. In 2025, the threshold was $600. Beginning in 2026, it changes to $2,000. Okay, so if it's anything under $2,000 in 2026, you do not give them a 1099. Then the next step is, well, how did you pay them that $2,000 and more? If it is pocketbook to pocketbook, in other words, bank to bank, cash, check, ACH, debit card, or like a personal Venmo, not the business Venmo, but a personal Venmo, then you count all of that. If you paid with a credit card or you used PayPal, then that part you don't count. And that's probably the most confusing piece right there. It's how did I pay them? And then the last, if after you get down to, well, I paid them with a debit card and I paid more than $2,000 and they did a service for me and I am a business, the last thing that you need to know is, are they a corporation? Well, as we learned earlier, an LLC could be taxed as an S corporation, and you will not know that unless you have their W-9. So best practices is to get the form W-9 before you pay for that service, right? It's actually best to get it before you agree to have them do the service, right? But at very minimum, get a form W-9 from them. There's a fillable form that the IRS has that's free. You can have them fill it out online, sign it and hand it to you, or sign it electronically. That's fine. But get that form W-9 because that's the only way that you will know if they checked a limited liability company box in that middle section there. If they checked that and they put a C or an S on the right-hand side, then you do not give them a 1099. If they checked sole proprietor, then you would give them a 1099. Now, one thing I do want to point out in 2026, now this is in draft form. Since 2023, right, Kathy, I think? Since 23, you have been able to use your employer identification number on Form W-9. The draft proposal for 2026, it hasn't come out yet. In theory, it's going to be around March, but they're changing the wording on it, apparently, to say that you have to match your taxpayer identification number with the name that's on the tax return that you are going to file. So what does that mean for you? Okay, well, if you as a business owner have to fill out a W-9 because you did a service for someone, then in 2026, if this all comes down the pike like they say it's going to, then if you are filing a Schedule C as a sole proprietor, even if you have a limited liability company, you're going to have to put your name on line 1 and your social security number on the W-9. So this is a change that's going to potentially happen. Keep watching Kathy and I, because we'll come out when they finally announce this. We'll come out and let you guys know. But just be aware that this is a big deal.
Yeah, it is. I know our audience didn't see, but I don't know if you saw this past week with the TX CPA had their little exchange, and that went back and forth with a lot of practitioners talking about this issue because, we used to say that, get a federal ID number because we were concerned about the potential of, identity theft and everything. I mean, I don't know about you, Lisa, but I don't like my social security number being out everywhere. And so I understand from the IRS's standpoint, they're trying to match to make sure you guys, everybody is, picking up all the income that they should be. But I was just going to say that since, last week or in the last couple of weeks, I've been doing 1099s for some of our clients. And looking at these W-9s, very much because, a lot of times you don't know, like you said, whether or not you're supposed to do one for somebody. But I see so many of them that are not filled out correctly. And a lot of times I will see that the LLC box will be checked, but then they won't say, what they are. They won't say if they're a partnership or if they're a, S corp or exactly what they are, or they'll say that they are an individual sole proprietor, but they'll put a federal ID number on there. So what do you do in these cases? Do you call up the person and say, hey, this form isn't filled out appropriately?
Well, that's what the IRS wants you to do. If you, as the business owner, file a W-9, an information report that you're required to file, and the taxpayer identification number does not match the name in line 1, you could get a fine for $60. And if you continue to use that vendor, you would be required to withhold 24%. Yeah, 24%. And then give that to the IRS.
Yeah, it's backup withholding, yes.
So if you don't want the extra administrative work and the headache of trying to explain to this vendor why you're withholding 24% of their money, make sure that they fill it out right too, which, I mean, we shouldn't be responsible for their bookkeeping, but we know that this could come back and bite us. So it's really important that we make sure that they filled it out right so that we can give them the correct 1099. We can report 1099s correctly. The Form 1099 NEC was due January 31st. There is a free IRS filing thing for it now. I highly recommend that you file electronically. You cannot give the IRS a paper copy unless it's their particular form. And that's really hard to come by nowadays. The IRS has this free way to do it. In addition to that, there are a whole bunch of other services out there like Tax 1099 that will do it for $3 or $4. It's not really that expensive, and right away whether or not it matches those taxpayer identification numbers, right? In addition to that, if you have more than 10 the IRS says you must file electronically. You cannot file on paper. So just keep that part in mind. There are some other types of 1099s that, other than the 1099 NEC, the 1099 miscellaneous, oftentimes where you'll find that you'll do that one is if you pay rent. And keep in mind that if you rent studio space, that counts. Now, again, in 2026, the threshold is going to go up to $2,000. So maybe you'll just be under the threshold. But keep in mind that these other types of 1099s are out there. We talked a lot about hobby versus business already. It's really more of how much do you look and act like a business? And the more you look and act like one, you have a separate business bank account, business type bank account, not just a checking account that you've designated as business, but an actual business type bank account. You have an EIN, you have a more formal way that you're doing your bookkeeping. You don't just have this shoebox of shame. All of those types of things start to make you look a lot more like a business. And then, you won't really run into this hobby rule that says that the IRS might come back and say, sorry, you're just a hobby and you don't get to take all of these deductions that you have on your Schedule C, and then you would owe a lot more taxes. Oof. So here's a full list if you want to take a screenshot right now, just to kind of get that into your head. But again, it's when you have that intent to make a profit, it comes out in the way that you do things. Even if you're not making one yet, as Kathy pointed out, that's okay. You just really need to look like it, and you need to look like it consistently. So if you do have a hobby, I want to make sure that you understand that you must report that income. So if you are a freelancer, you just have a gig now and then, if you played at your sister's bar mitzvah, if you at her birthday party, there we go, you still count that money. And the problem is, or the problem is not quite the right word, but the difference between the business and the hobby is the hobby, you don't get to take any deductions. I had a buddy, Denny, that was a woodworker, and he said, okay, if you'll just pay me the cost of the material, I will make this bookshelf for you. Well, the IRS says all of that money that he got, he had to claim, even though he used it to go buy material. Now, if they had given him the material and he had just put it together for them, it would have been different, right? But because they gave him money, he had to claim that on his federal tax return. And he didn't get to take the material. So it's not like he got to bring it down to zero. That's a business. Doesn't look like we have any questions. Remember that if you are watching us live on YouTube, you can put them in the chat, and we've been answering them live as we go. So don't forget that. And Kathy, talk to me about what can be deducted if you really are claiming to be a business.
Well, I'm excited to see that in a couple of weeks you're going to be doing just a specific hour long about what business expenses are deductible. So I don't know that I'm going to let everybody want to go to your class to get the actual, but you did mention something when you were talking earlier about setting up somebody's books. And, I have, we didn't have it in the slides, but I have the actual Schedule C, because that's exactly what I do. And that's exactly what I tell people. When we talk about expenses or deductible, I wished I could give you a whole list, and maybe you are going to give them in your class. Maybe you'll give them this whole long list. But when you think about, visual artists and musicians and public artists and all these other different, creative writers. I mean, we think about, artists, there are, a lot of different types. A visual artist is going to have something totally different than a creative writer as far as what business expenses they're going to have. So, the Schedule C, which is generally what most people would be, looking at first, is it has a lot of these, typical expenses on here that most people would have. As you were saying earlier, advertising, we've got, car and truck expenses, contract labor, if you're getting somebody to help you, commissions and fees, depreciation, insurance. We talk about, the type of insurance that you get. If you get the general liability insurance for your business, that's a deduction. When you think legal and professional fees, now, thankfully, TALA is not, something that, that's not a professional fee, because that's actually would be considered a dues and subscriptions. Office expenses, rent and lease of equipment, repairs and maintenance, supplies that you're buying in, if you have inventory, those kind of things, travel, meals. I mean, the list is endless, really. And so the way I always have looked at it is basically what is it that you have to buy, or what service do you have to, get in order for you to be able to do your business, whether you're making something or whether you're doing it as a service. So, that's how I generally look at it. Now, there are going to be some deductions that have some limitations, and meals is one of them, because unfortunately meals are back to being only 50% deductible. And dang it, and it doesn't matter whether those meals are in town or whether you go out of town. It doesn't matter, because I see a lot of people will say, hey, well, these are my meals out of town. It's still 50% whether you're in town or out of town. So that part doesn't really matter.
Yeah, the IRS, I guess they figure we're humans. We have to eat anyways, whether we're businessing or not. And so, that's the only thing I can think of.
Yeah. And I'll also throw out the fact that we've kind of, for many, many years, right, we would always put meals and entertainment together. That was the typical label, meals and entertainment. But, entertainment went away quite a while ago. There's no entertainment. And when I say entertainment, most of what we usually refer to is, going to a Rockets game, going to, an Astros game, or going to, sports events and things like that. Rodeos coming up here in Houston here pretty soon. Those kind of things, if you're going to, take a, potential customer or whatever, to wine them and dine them and then take them out to the game or whatever. The meal, if it's separate from, the cost of, if you get a chance to go to like some box or whatever up there, the meal that you have, if it's separate from the cost of the box that you would be sitting at, is 50%. But that ticket to the game and whatever, that's entertainment, and it's not. Taking people, we used to have clients where they would take them hunting, no, that's entertainment. So those items aren't something that we can deduct. But meals, yes, as long as you're discussing business at that meal.
Yeah, it has to have a business purpose. So
Right.
now, if you are out of town for business at a conference or at a concert that you're performing at, yes, of course, that's, even if you don't talk about the concert while you're at that meal, because you're forced to be out of town for that concert, that is acceptable. But if you just stop at Starbucks on your way home from the studio, that's not a
No.
business meal.
Well, mileage, one of the other things that we always have a long conversation on is mileage. When it comes to your automobile, or when I say automobile, that could be your truck or your SUV or van or whatever, just using that as a broad topic. But you either take what we call actual expenses or you take mileage. Now, when we talk about actual expenses, what we're referring to is the cost of gas, oil, repairs, those kind of things, tires, those type of things. You can deduct that, or you deduct mileage. And as you can see here, and boy, it's just keeps going up and up. It's 70 right now for 26. It's 72.5 cents per mile, and that covers all of those actual, what we consider actual expenses. Either way you do it, whether you take actual expenses or whether you take the mileage, you have to keep a mileage log, because when you're taking that, yes, I know it's mile IQ, right? Isn't that, I think everybody is doing that's free, right? And
Yes.
There's all these kind of apps, and it's very, very simple. But when you're taking, if you're using, if you have, if you only have one car and you're using that for both personal and business, then you have to be able to determine how much usage of that car you're using for business and how much you are using as personal. And the only way you can do that is keeping a mileage log. And so, that's why it's important to keep a mileage log, no matter which you choose. Most of the time people take mileage. It's so much easier, and it does a pretty good job of giving you a good, overview as far good dollar amount of deductions on that. There are limitations. I'm not going to get into all of the limitations about, well, if I'm getting that SUV that's over 6,000 pounds and I can write 100% of that off, that's, I don't know, Lisa, if you're going to cover that in your expense topic, but that can be another topic for another day, because we just don't have a lot of time.
So we do have some, a little bit of comments in the about how commuting is not a deduction. That's correct. The other thing that I've seen a lot for whatever reason this year is a little bit of confusion about, we tell you must keep all of your receipts. We want every single one of your receipt. And so if you use your personal vehicle for business purposes and you put gas in your car, yes, we want you to keep that receipt, but not if you're going to do the simple mileage. You can't take both the 72.5 cents per mile and the full version. So you can't put gas in your car and count that $20 and take 72.5 cents.
Right.
For that mile.
Correct.
I know it's a little bit confusing, but you got to choose one or the other. Oh, by the way, if you choose the non-simplified version, you got to stick with it. Once you do it once, you got to stick with it. The simplified version is so much easier. And the 72.5 cents, that covers gas, maintenance, oil changes, insurance, right? And
Yeah.
then you don't have to worry about keeping all of those receipts
Right.
for
Depreciation.
right.
Yeah,
It just
all of that.
it's just like such a
Mm,
mess.
yeah, interest too, by the way, because if you're buying the car and you're still paying, payments on the car, that interest expense is also considered part of the
Part of the whole
actual,
thing.
the actual expenses.
Mm-hmm.
But I would imagine, certainly whether you're living here in the Houston area or whatever, but I'm sure in the Austin or wherever, you know, we drive everywhere, and you don't realize, you're sure I know everybody hates the fact of having to keep a mileage log, but you don't realize how much miles you really drive around every day until you start keeping track of that. So don't think, well, I did 10,000 miles. No, because it could be more like 15,000 and you're shortchanging yourself. I will say
Absolutely.
about the auto, though, is that we're talking about the automobile, but parking and tolls are separate. So in other words,
Separate, yes.
you can go ahead and that is a separate thing, and keep track of your toll charges.
Keep those receipts. Keep
Keep those,
those receipts.
and we're talking about keeping receipts, but I imagine a lot of the people that are on this video, or they'll be watching this later on, are probably, in the, I'll say a little bit of the younger crowd or whatever. They probably are very easy, can take pictures, do JPEGs, do PDFs from your phone or whatever. You don't have to have the physical, necessarily receipt, but you have to be able to produce that receipt. So the IRS is very fine about being able to take electronic versions of these receipts. So
Yay.
yeah. And the only other thing, which is kind of not necessarily part of this about the new tax bill, but from the business side, one of the new things, well, we were talking about a little bit about depreciation. One of the things that the new bill act came out with is now, if you buy a new computer, or if you buy, some desks and chairs, or, whatever, something that's an asset that you're going to use in your business, we have now back to the 100% bonus depreciation, which means that you can write 100% of that off. And so it would have been 40% this year, but I will say, and I want to make sure I have the date right. That 100% bonus is got to be placed in service after January the 19th of 2025. So if you bought a new computer on January the 5th, you'll have to, if you want to do bonus depreciation, it's only 40%. So there is a due date on that. And I will tell you, our software, does it correct, because I put somebody in and I'm like, why isn't it not showing 100%? And then I realized it was like January the 9th or something. I'm like, oh, okay, well, no, we can't do 100% then. So, but
sure.
Talking about this new bill, we had quite a bit of there's quite a bit in this bill. A lot of it is for 25. A lot of it is for 26, and even some of it is actually for 27. So it's kind of difficult. I don't know, Lisa, if you have it, but I have like a little table that, I got from AICPA or someplace, where it has like all the different ones and what year it is effective. So this is something that we have to, kind of look at or whatever. But here are some highlights, I guess, if you could say, that I'm sure that we're going to definitely be dealing with this year. And most of these are new, with the exception, maybe of the SALT deduction that's coming back to life. But tips for, as you said, for 2025 to 28, Artists who earn tips may be able to lower their amount of income by $25,000. This is going to be, we're dealing with it with people that are tipped employees who are actually getting a W-2. And those W-2s, in case you may be getting W-2s for something else, maybe you work and do this on the side, because a lot of people do. That W-2 for 2025 is not going to be necessarily changing in 25. So we're hoping that some of the employers are going to be, the tips should already be there on your W-2, that dollar amount or whatever. But, it's going to be interesting to see how this is going to work. And especially also with the overtime deduction. Remember, on that overtime deduction, what, is only that halftime, because remember, on overtime, you get time and a half. And it's only the halftime that is going to be allowed for this deduction, which is up to $12,500. And once again, it's not going to be, unless you happen to have an employer that's been kind enough to put it in that box 14, which is kind of other information for 25. It's not going to be on there. You may have to use your last pay stub that you got from them, because that's what we're seeing. And I've seen 3 different pay stubs that are showing it 3 different ways. So it's going to be interesting how this is going to work out. But I will say that the IRS realizes that this is going to be kind of a mess. And so, they're giving us a free ride, if you will, as far as being, if we happen to do it wrong, they're not going to come back at us for that. So I haven't looked with respect, going back to the tips, Lisa, have you seen how that's going to work with the Schedule C?
Not yet.
If anybody does, is anybody get tips that,
Well, think about a musician or a band that they have a little tip jar out on the edge of the stage, right? They're not gonna get a 1099 for that. They're not gonna get a W-2. They're not gonna get anything that proves up those tips.
Right.
It's gonna end up, I think, on them to have really good records that says, I got this amount from the bar that I played at for regular wage, regular income, and then the tip jar was this amount. So
it's going to be on, on your best behavior kind of thing. That's true. And I do know the other thing that keeps coming up that we've been hearing is with respect to restaurants. Normally when you go to a restaurant, they ask you for, how much you want to tip, right? And you put whatever you're going to do. But if they are telling you that you have a party of 6 or 8 or something, a large group, right? And they're saying, you are required to, we're going to charge you, 15% or whatever for a large group.
Automatic gratuity.
That's if it's something that you don't have a choice on, then that's going to be something that would not be applicable in this case. It's not considered a tip. So this 25 is going to be kind of a little messy or whatever, but we've kind of got a free ride from the IRS. So I do the best you can. And like you said, try and keep as good a records as you can, and just have to go from there. We talked about the car loan interest. I started doing taxes back in 1984. So that tells you how old I am.
Good year. Good year.
And, but in 1986, we used to be able to deduct our car loan interest on our itemized deduction schedule, but that went out with the 1986 tax law. and now they have brought this back, that you can do this now.
Nice.
Yes. And so if you're not using, now this would not be applicable for, if you're using your car in business, this wouldn't count. This is if you're not, like in me, I don't use my car for business, but if I bought a new car in 25, and I can subtract up to 10,000 in interest payments, and I do believe that people are now getting an interest statement from the the car companies or whoever they're buying that from. It has to be a new car. It has to be doesn't have to be final manufactured here in the US. So there's a few other little caveats on that, but that'll be nice. So sorry, all those people that bought the new car in 24.
Oh, right. That sucks.
Yeah, because I had some people that did that. We've got this new, so we're talking about this baby bonus for, I haven't really seen much on this at all. Lisa,
Oh,
is this
well,
not the Trump accounts, is it?
yeah, this is the Trump accounts.
Okay, yeah, nobody's talked about that I've heard at all.
I've seen quite a bit on it. Maybe it's because I've got 2 younger grandchildren, and everybody's having babies or something. I don't know, but yeah, if you had a kid in 2025, you could get this extra $100 thrown into an account for them, so that they can kind of start their retirement plan already. So just be aware that it's out there. If you've got brand new little ones, come ask us more about it.
Yeah. We talked about the SALT deduction, which I'm not sure that we have maybe a lot of people that have had this. I know the clients that I have at the office certainly has, because they had, when the Tax Cuts and Jobs Act came out in 2017, then they had capped the property taxes that you could deduct. It's really property and income taxes, since we are in Texas and we don't pay income taxes. This really didn't affect us, but it did with our property taxes. But they capped it at $10,000. So I know there's quite a few school districts around Houston that, people are paying, $20,000 and $30,000 for their property taxes, the total of the school and the county and the city and all of that. So now, and so that was capped at the $10,000, but now it's up to going back to 40. So a lot of those people that were not able to, deduct the full amount of their property taxes will be able to, hopefully this year.
Hey, Kathy, we do have a question in the chat about the vehicle. I believe it's about the vehicle deduction. If you take the standard deduction and don't itemize, then do you still get it?
No.
I know that the tips and the overtime, it doesn't matter whether you itemize or not, but I believe the vehicle is only if you itemize.
No, with the vehicle, you have to be able to itemize.
Yeah.
Otherwise you're not going to be able to take this. But, some people, are kind of like a little bit on the cusp. So maybe, this is something that will, push them over to that. And, I'll just throw this out. This is the good thing about having somebody that knows about tax law and tax planning. This is these types of things are good planning opportunities where you can, look at that and work with that to maximize the benefits that you had. So the car deduction is on your personal. Yes, it's when we're talking about this, we're talking about the personal, because like I said, if you happen to have if you bought a new car last year and you're using it in your business, then this would not be something that you would do, because with your car in the business, you're going to be using that in business, and it would be on your Schedule C or wherever else if you're doing a corporation or whatever. So this is just specifically personal. The senior deduction, this is great. You know, I am a senior, but unfortunately, I'm not going to be able to take this wonderful $6,000 because I make too much money. So yeah, dang it. But this is really going to be helpful. It's $6,000 for each spouse. So it would be a total of $12,000. And then, you know, charitable contributions. I'm a huge charity contribution person. And
give to TALA.
Yes,
to TALA.
and you know, it's not showing here on the slide, but I should have mentioned to put it in here. In 26, yeah, one thing in 26, if you are not able to itemize, then you can, for a single person, for 26, you can take up to $1,000 as a deduction, you know, before taxable income. And if you're a married filing joint, 2,000 up to 2,000 for cash contributions, not your clothing or, you know, clothing or household goods, but cash. So deduct, so give to TALA, and then you'll be able to have a deduction for, because I can't, you know, myself, I can't itemize. I don't, you know, my taxes are low now because I'm over 65. My house is almost paid for. So I can't, my standard deduction is way higher than any of my itemized deductions. But now I'm excited because I know I will definitely have $1,000 worth of charitable contributions in 26 that I will be able to deduct. So certainly that is a great thing, and I'm really excited about that.
So that is one example of you don't have to itemize to get this particular one.
Absolutely, that is correct. So exciting. So there's a lot of stuff that's on there, and let me see if there's anything else. So somebody had asked something about the home office, and I'm getting ready to talk about that. You know, the IRS allows you office and home deduction. And generally what we're talking about is, and I'm a pretty good example where I'm at right now is I have a formal living room and a formal dining room that, you know, I have a breakfast room and I have a family room, right? So I've got two rooms that I don't use, except this is my office. So I'm using two rooms out of my whole house for my home office. And so, for my clients, I do a Schedule C and I do office and home. And so what you do in order to calculate that, what you do is you take the total square footage of either your home or your condo or your apartment, depending on, you know, where you live. And then you take the square footage of the room that you're using in business. Now, it's got to be exclusively used in business. So in other words, you can't use, you know, your bedroom and then you have a little, you know, desk over there. No, you can't sleep and have your desk there. It's got to be totally separate. And then you will, so you'll divide that room or rooms or whatever, divide it into the total square footage, and you get this business percentage usage. Then we have what we call, and this is going on the Form 8829. When you pull that up, there's two columns. There's a direct expense and there's an indirect expense. And the direct expense is, well, let me go back. The expenses that you can deduct for if you're in a residence, right? Mortgage interest, property taxes, insurance, homeowners insurance, you know, those kind of things, repairs, utilities, security, you know, security alarm system, those kind of things. If you're in an apartment, then obviously maybe you have renter's insurance, your apartment rent. Of course, in your utilities, you wouldn't have any repairs or maintenance because that's covered hopefully by the department. So you have direct and indirect, and your direct expense is directly for that room. So if I decide to repaint, my room, you can probably see it, it's kind of red. If I decide I'm going to repaint this room blue, then that cost is going to be directly for this room. But if I decide that I'm going to recarpet the whole house and include this, then that's going to be an indirect expense. The utilities are an indirect expense because it's for everything. It's not just for that one room that I'm in. And so those are the difference between direct and indirect. And there's usually two things: lawn care and homeowners association fees. Those two are not considered as office and home expense. And then depreciation, even though a lot of times people don't want to depreciate their house, the IRS's rules are considering, yes, you need to, you still, even if you don't depreciate it, they're going to continue to consider that you had, because there's if you sell the house or whatever, then there may be some consequences as a result of that. Right. Going back to what Lisa's been saying, I don't want to say preaching, but saying, keeping expenses, right? Okay, so you're going to do all this. You've got to keep your utility costs. You're going to have to keep all of, your repairs and things like this. And so if you don't want to do that, then the IRS back in, when was that, 2013, I think it was. Yeah, 2013. They did they put a simplified method in. And basically what they're saying is that they will allow you to take, did we lose our slides?
Apparently we lost our slides.
Uh-oh. That they'll allow you to take 300, it's a total of $1,500 as a flat rate. So, as the home office expense. So it's a total of $1,500, and, that way you don't have to keep any kind of records, which is nice. So if you don't want to keep all of those records, but, you almost have to know, how much, what you almost have to at least calculate it at one point to see, is it really worth me doing, going through all of this hassle, of keeping all these records, because, I think you would be doing yourself a disservice, not, because most people's deductions are usually more than $1,500. So,
right.
So I guess they had some questions here. Yeah.
Most of them we've already answered, like the fact that there's really not, you just need the receipts for the cash contributions,
right?
The charitable contributions,
and I will say that those charities are required. If you give them, $250 or more, they're required to give you a receipt. Now, most charities will, when I say charities, I'm kind of using that as a broad example. It could be your church, or, a nonprofit organization. They're usually going to give you, a receipt for how much you gave them anyway. But yes, you do need to keep track of that. And
sure. So one thing I wanted to mention, we're going to move on a little bit, even without the slides, is last year in 2025, we had a beneficial information ownership report that we had to do. They have taken that off the table. So we just wanted to let you guys know that is no longer a requirement. So that's an update there. And Kathy, can you talk just a bit about the quarterly estimated taxes and how all that works?
Yeah. Okay. So we talked earlier about the self-employment tax, which, is based on what the net income of your, Schedule C is. And, it's difficult to, a lot of times, what we normally do from our standpoint is we will take what people's, because it's not just, if you have income from other sources, whether it's your other source or whether it's your spouse's other source, you can't just only use what you've made from your Schedule C unless that's the only income that you have. You have to look at it from your whole total income standpoint, and you have to determine, well, what is my tax liability? And I know a lot of times, it is based on an estimate. So, you would say, well, for example, if my total tax liability ends up for the year to be, let's say, make it easy, $12,000, for the whole year, then, I'm going to need to at least put, one, per the quarter, I need to at least put 1/4 of that in as estimated tax payments, which are, as we talked about, they're not every 3 months. Usually a quarter is every 3 months. And, that doesn't quite work out that way because the IRS has them, April 15th and then June 15th and then September 15th and then January 15th of the following year. And so we've kind of, a lot of, artists and people say, well, how am I going to know, my income is, this way. It's like, my EKG or something, it's up and down or whatever, it's not the same all the way around. And so I think, because what you're looking at is the self-employment tax is a total of 15.3%. And that is, part of the 6.2, which is your Social Security, 1.45 is your Medicare tax. And then, as Lisa said, so that's 7.65% that's withholding. That's what they withhold from you if you're doing, if you have a W-2. But you're also paying over, so you're paying that plus the employer part. That's where the 15.3% comes from. But then that's just on that Schedule C business income. So if you have other income, then you do have other taxes, then you do have other regular taxes on everything else. So if you're in a 10 or 10% tax bracket, normally, then you've got that 10% of tax bracket plus the 15%. So now you're looking at a total of 25% in total tax. So normally what a lot of times we tell people is, look, just hold back, 15, 20%, even, it's nice to, hold it back maybe every time, depends on how disciplined you are. If that means that every time you get money from a customer, hold back 20%, just put it aside, put it in another account. Pay it over to the IRS. I don't care how you do it, but have it to where at least you can make these payments so that you don't get hit. Because if you don't put enough in during the year and it's time on April 15th and you owe money, then you're going to get penalized for not putting enough in during the year.
That is the risk. That is definitely the risk.
And, if you overpay, then you can either do one of two things. You can get the money back from the government, or you can apply it to your next year's tax return. And I will just, I need my IRS hat on. I'm sorry. I'm going to put my IRS hat on for a minute. And if you have not gone online to the irs.gov website and set your own account up, do it. It doesn't cost anything. Do it because they are really working hard to update and get more into, the 21st century here because as we all have probably heard, their funding's been cut, their staff is just almost non-existent now, it seems like. So they're pushing people more and more to do things online, and it is really a good thing to go online. You can make your estimated payments online. You can pay, if you have any questions about, well, I don't know how much I paid, you can go online and find it. You don't have to call the IRS. You don't have to, try and figure out what did I pay or whatever. It's a wonderful thing. Even if you don't have your own account, you can go on to pay. If you have an old balance or something, you can just go on. You don't have to set up an account. You can go online and pay it directly online. And it's really very simple. My only thing that I would tell you, only because this happened to a client last week, when you go online and you make your payment, make sure that when you're putting the dollar amount in, that you put the period in, because they were going to pay something like $390, but she didn't put the period. And so it ended up taking $39,000 out of her. Well, thankfully she didn't have the money. She didn't have that much in her account. But she caught it and she called us immediately. She goes, "Oh my God, I just did something wrong. I didn't put the right number in there, the dollar amount. What do I do? How am I going to get this back?" And, luckily we were like, "You better call the bank, because, once it's gone, it's gone." Well, because she didn't have that kind of money in her account, it was rejected anyway.
Yeah.
But
oh my goodness.
Just always be careful when you do that. It does give you an opportunity to review it. So just because I would hate to see anybody put the wrong dollar amount in, but it can happen. So
for sure. Oh my goodness. Yeah, they really are pushing for electronic everything.
Yes.
Electronic filing of the 1099s, electronic payment for everything. It's pretty easy to get.
Yeah. And I will say too, just in case you guys haven't heard, if anybody, it's hard to imagine that people nowadays aren't, when they're having a refund, that they're not getting that direct deposited into your account. But if by chance, you're some, stalwart, I'm going to have a paper check no matter what, it ain't going to happen this year. It's going to be very hard, because if you do, when you file your return and you get a refund, if you don't have it direct deposited into your account, then what the IRS is going to do is they are going to send you a letter saying, "Hey, I noticed, that you didn't have an account. Please give us your account so we can deposit your money." And, if you decide to give it to them, then it's going to be 6, 8, 12 weeks. God only knows. It's going to delay your refund.
Oh, I can't imagine.
If for some reason, you don't have a bank account or there are other ways of getting that otherwise, then they will mail you a paper check, but it's going to be way, way delayed. So don't do that. And although you can still send the IRS money via a check, it's best to do it online, and it's safer. And I don't know about you guys, but our post, office people are horrible. So
note on that real quick, as we're almost wrapping things up. At the beginning of 2026, the post office changed a little bit about the way that they postmark things. And so you used to be able to go in to the post office and get your tax return postmarked on 4/15 at the post office. Now it's not going to count until the post people take it back to their headquarters, basically, is the way that it works out. And so that could be a day or two later, which would mean that your tax return could be late if you don't go in. And if you're going to do it in the mail, get it certified return receipt, because that will get it postmarked right then. You can't just put it in the mailbox now and expect it to be postmarked that day.
Yeah. Electronic filing.
Electronic filing, yes.
Electronic filing. Well, I know we got a couple of other questions, but I just want to, I want to at least touch on, these are some other taxes that you will probably have to pay at some point. Sales tax, I'm sure some of you already probably know. We could, sales tax is a whole nother topic. Payroll taxes, payroll taxes is if you're actually paying, individuals. Usually, if you were talking about grants, sometimes, people will get grants and usually will get a 1099. Certainly if you get a 1099, most of the time you're going to have to pick it up. Lisa already talked about the BOI reporting or whatever. We talked about the franchise tax. Just know that anybody, if you're basically everybody has to file something with the state unless you're a sole proprietor. And, you don't have to pay anything unless you've got 2.47 million of, sales. But you do have to file what they call the public information report, which is just basically your name and, that you're a member or whatever you are. But I want to go to the business personal property tax just real quick, because that keeps coming up. Business personal property tax is you have to render your the assets that you use in business, if you will. So we're talking about, inventory, equipment. You do have an exception on auto if it's, we talked about the personal auto, using personal and business. You don't have to do it on that. Your computers, printers, those kind of things. And it's
chairs,
desks, right. And basically, of course, I'm used to Harris County because that's what I'm in. The rendition forms are what they look at is what is the assets that you have as of 1/1 of 26, right? So 1/1 of 26. But it's really based on what you have bought and what you have in 2025. Usually we get that information from your depreciation schedule. And then you render the property. It is due on April 15th, which is not a good day, but it is due on April 15th. And you can, if you don't render the property, then they will penalize you for not rendering your property, or they will come out and decide how much it is and then send you a bill or whatever. But I want to say that I've seen this way too many times. As a matter of fact, I'm a treasurer of a nonprofit organization. We just got and I'm like, why are we getting this, appraisal district thing? And what happened is we moved into an office building for about 2 years, and then we left because they were going to tear the office building down. These appraisers, I don't care what county you're in, but they will go, if you think, if you have an office, or if you have a physical location, or if you rent space in a studio that's in a strip center or whatever, if you don't think that they don't know you're there, they know that you're there, because they will go, and then all of a sudden you'll just get this, and like, well, why am I getting this? Because they've gone there and they've seen that you've had a business there. So be wary of that. So let me see. I'm not sure. I was going real quick on the questions. I'm not sure what they mean about the TurboTax. I'm confused.
I was a little confused about that myself. And then, but there is a question about business personal property tax. Again, I'm not 100% certain.
Oh, that's right. Well, they're asking, do we still have to complete Schedule A of the business personal property if we have filed it before, but we have less than the new exemption? I don't think so. I have not started doing one. Our clients are just now starting to get the forms. So I don't believe that we would have to do that. And I don't know about this person, but I always file them electronically on the county's website. So that may already be,
right.
Calculated into the filing there. So
The filing, yeah.
yeah,
That's the way Travis is also. Not all the counties in Texas are electronic.
that's true.
Some,
That's true.
but I've not run into one yet that won't at least take an email, right? So you fill out the form online and then email it to them.
Yeah.
So like I agree. I believe that the answer is no, you don't have to file that part if you are
Right.
no longer applicable. So
Right.
um
Okay. Well, it's 8:32.
and Kathy, we've come to the end. We've had a lot of questions, a lot of interaction from you guys. Really appreciate the enthusiasm with regards to taxes. Elisa, why don't you remind us about when all of the other things are going to happen, even before taxes are due?
Sure. Thank you so much for all of your information. It's a lot, but it's all very important. We do have 2 upcoming opportunities. I just want to remind people about more on deductions. So if you have questions, the deduction hour, 2 weeks from today at noon, basically. So join Lisa for her hour just solely to talk about deductions. And then if you need help as the tax date nears, 2 dates, Monday, March 30th and Monday, April 6th at 6 o'clock, 6 to 7, come and speak with either Kathy or Lisa in a breakout room for your own individual questions. So hopefully with all of this information and you're trying to do your taxes yourself, that this is helpful and you can get them done and get them done on time and correctly. So I guess that's important. I think that's about it for tonight. Special thanks for the Houston Center for Contemporary Craft for hosting a watch party for us and for supporting us and being friendly. Fresh Arts, too, can't say enough about them. If you are in Houston and you don't know either one of these organizations, you need to look them up when you get off of this call tonight, because they're both helping artists all the time in Houston. Again, Houston Center for Contemporary Craft and Fresh Arts are partners for tonight, and we're so appreciative to have them. And I think that concludes us. We are saying good night. Please feel free to contact either one of these ladies or contact us, and we will attempt to get your questions answered or get you in touch with them. So thank you and have a great evening.